Hello, good day. So, for this week, we are looking at IAS 28, IFRS 11. Today, you've covered some questions in IAS 28 where you have applied equity accounting. One of the questions is on consolidation with associates, and I want you to pay attention to that. You know how to account for an associate, and I want us to go through accounting for consolidation, which includes an associate. So the earlier questions, question 1, 2, 3, are just purely on associates, and 4. And question 5 and 6 is about having a parent who has a subsidiary and has an associate. So the parent will consolidate the subsidiary and equity account the associate. So you have tried question 5. Now let me walk you through question 6. And question 6, you will go back into your groups and discuss question 6. You will go back into your group and discuss question 6. So we will not solve this question at tutorials. You will go back into your groups and have a conversation around question 6. And to help you go through, I am sending you this recording. So Pray Limited acquired 80% of Sing Limited on 1st December 2016, paying 4.25 in cash per share. At this date, the balance on Sing retained earnings were 870. So when you think about it, your structure for this is 80-20. And since the acquisition is on 1st December, you have December to November 2019. So 2016, 2017, 2018, 2019, that gives you 3 years of consolidation. 3 years. Now, on 1st March 2019, Pray Limited acquired 30%. Now you see 30%, you don't need to be told. It is an associate. The consideration was settled by a share exchange of 4 new shares in Pray for every 3 in Adore. So the share price of Pray at the date of acquisition is 5, and Pray has not yet recorded. So from this information, it means this, as far as this question is concerned, has been recorded, but this second one on the associate has not been recorded. So you pay attention to that and we work on it. So you have your financial statement. You must pay attention to look at the figures you have in the financial statement. PPE, investment, inventory, receivable, cash and cash equivalent, share capital, share premium, retained earning, loan, all that. Now let's focus on the footnote, which is what I'll be taking you through largely. As at 1st December 2016, date of acquisition, plant in the books of Sing Limited was determined to have a fair value of 50,000 in excess. So we have fair value of plants of 50,000 in excess. The plant had a remaining life of 5 years at this time. And so you must remember 50,000, fair value of 50,000 divided by 5 years. And because we are doing consolidating for 3 years, that will go for 3 years. Working 2, under working 2, fair value adjustment, and then the depreciation on that. During the post-acquisition period, Sing Limited sold goods to Pray for 400,000 at a markup of 25%. Pray had a quarter of these goods in inventory at the year end. So Sing sold goods, subsidiary sold goods, subsidiary sold goods. And because it's subsidiary, you can add it to the net asset working too, or you can report it separately. Do what works for you. So we are taking a quarter of these goods because we are told that um, Singh sold the goods 400,000 at a markup. So we are changing the markup to margin first of all. So it will become 1 because markup is 1/4. Margin will become 1/5. 1/5. You use 1/5 as the margin here. And Pray Limited had a quarter of the goods still in inventory. What will be a quarter of 400,000? That will be 100,000, right? Because it's a quarter. Quarter. So it's 100,000. So your unrealized profit on this will be 100,000 divided by 5. And so that will be your unrealized profit. If you do that calculation, what will you be getting? Yeah, work on it. Then in September, Adore sold goods to Pray for 150,000. These goods had cost Adore 100,000. Pray had 90,000 of these goods in inventory at the year end. In September, Adore sold goods to Pray. Adore, the associate, sold goods 150,000, and the cost of the goods were 100,000. So it means Adore made profit of 50,000 on the goods. So this is the cost to Adore. This is how much Adore sold it, 150,000. So there is 50,000 profit on sale as far as the associate is concerned. Now Pray had 90,000 of the goods in inventory. 90,000 of the goods in inventory. So you calculate unrealized profit on 90,000, but where the associate is concerned, you only eliminate the parent's share, which is 30%. The parent's share, which is 30%. Now, first of all, the profit loading in this is like markup of 50%. This is at a markup of 50% because if you take the profit of 50 over the cost of 100, it is half. So profit of 50%, which will become a margin of 1/3. The profit is 50,000, and so cost is 100. If you change that to markup, because this is profit as a percentage of cost, profit cost, you will get a markup of half, 1/2. That's why I said it's 50%, and therefore your margin will become 1/3. Or you can take 50,000, the profit, as a percentage of selling price, which means 50,000 over 150,000, and it is 1/3. So this is profit as a percentage of selling price. So this is your margin. And so if the margin is 1/3, and then 90,000 of the goods have not been sold, then a third of that 90,000 is your unrealized profit. And therefore that gives you a third of 90,000 is 30, then was it 339, 30,000. 30,000. So the total unrealized profit on this sale is 30,000. But um the parent share in the associate is only 30%. So they own it's only 30% of the associate unrealized profit will be eliminated, which is 9,000. Okay, 9,000. So as far as the associate is concerned, the unrealized profit to eliminate is the parent's share, which is 30% of the unrealized profit of 30,000. So it's 9,000, which will be eliminated. Then, as a result of the above intercompany sales, Praise Book showed 50,000 and 20,000 as owing to Singh and Adore, respectively. These balances agreed with the amounts recorded in Singh's book. Now, eliminate intra-group balances, but that is just between Pray and Singh, parent and subsidiary. The intra-group balance, no, the balance between parent and associate is not an intra-group balance. It's not an intra-group balance. So you do not eliminate that balance. So look at the trickiness of this. You've been given intra-group balances between parent and subsidiary and parent and associate. I'm saying parent and subsidiary, they are group members, eliminate, but subsidiary associate is not a group member. So the intra-group balance must not be eliminated. Non-controlling interest measured at fair value of at fair value. So, and the fair value of the non-controlling interest at the date of acquisition was 368. So now this is going through the footnote and thinking through what should be done. Let's see how all these play out. So as we discussed, this is the structure. We are consolidating Sync for 3 years, Adore for 9 months. Yeah, that's something you have to pay attention to. Adore for 9 months. And then we have parent 80 and NCI 20, associate 30%. Then your net asset. All these you can do. So it's not something I really will bother about. But this is where I want you to pay attention to. So this is the fair value, the plant, and then the associated depreciation. Associated depreciation. It's for 5 years, so what is left of it is 20. So you can see 60 has been written off. So it amounts to the same story. Then we have the unrealized profit on inventory, which is 20. You have your total net asset and you have post-acquisition loss. We've been solving questions as if every time it is about profit. Today, you have a post-acquisition loss, and that must be shared between parent and the subsidiary. Then you calculate your goodwill. Your cost of investment, of course, is 80% of 500,000 times 4.5. So if you see, this is 178, but the figure in the statement of financial position is not 1,007. Sorry, the cost of investment of saying is 1,007, but the figure in the statement of financial position is not 1,007. So it means there are other investment in it. Somebody asked this question: what happens when? This is an example of when investment will not be recorded. You don't have to do the double entry, and then some will be left in the financial statement of the parent. Then we calculate the fair value of NCI is given in the question. Then we take out the net asset as we have calculated in working 2. There is goodwill and there is impairment, which is also given in the question, and then goodwill at reporting. Your non-controlling interest, fair value, and then we are sharing the loss, and then there is impairment, their share of impairment. Then group retained earning, we are sharing the loss. Then there is impairment and there is fair value gain. So you see, the fair value gain in the financial statement, it is 1825, and 1,007 of that figure is for the cost of investment in the subsidiary, 1,007. And therefore, what is left, which is what you now fair value, and then there is the fair value gain of 15. Then associate. Now you have to work the associate and report the share of associate's profit in the group retained earning. Remember, share of associate profit. So this is share of the associate's profit, which is 135,000. How do we get 135,000? You get it by taking the profit of associates, and we are consolidating for 9 months. So it's only 9 months of that profit you take. 30% of that belongs to parents. That's how we are getting the 135,000. And from this, we take the unrealized profit of 9,000, the unrealized profit of 9,000. And then we also take out the impairment of associate, impairment of associate. So it all comes down to 111. Then when it comes to the investment in associate, I think we have it here. So this is what goes to the statement of financial position. Now you have to understand that it is the um associate that sold goods to the parent, and therefore the profit was made by the associate. And then in the inventory, the unsold inventory is in the group, is in the parent's book. So we'll take out the unrealized profit from inventory in the parent's book. Okay. But if the profit was made by the parent and the inventory was with associate, because we do not add associate figures, then it means we have to take the unrealized profit from the associate, investment in associate. So you must recall how to treat this. So cost of investment, share of the post acquisition profit, and then you take out the impairment. But the unrealized profit, it will hit the group retained earnings. So you are debiting group retained earning and you are crediting group inventory, because the inventory is with parents. So once you do that, you can go ahead and consolidate. This is where I end it. This is supposed to be a group discussion. Sit down, everybody go through the video, meet at your group, and put the figures together now in your consolidated financial statement. So we will not solve this in class, we will not solve it at tutorials. At tutorials, you are working on joint operation. Thank you.